Good afternoon, Angus, and good afternoon, members. Firstly, we'd like to apologize for yesterday's disruption to the webinar. It was a technical glitch that we did not anticipate with our GoToWebinar provider, so the system just wouldn't work and it just wasn't us. So we do apologize, and we thank everybody for understanding and joining us today. Angus, how are you?
Good, thanks, Pat. Apart from a few technical glitches, it's great to be here.
Great. So today's webinar is with Angus Geddes and myself, Patrick Ganley. There we are there, which a lot of you are familiar with. Some housekeeping, please be reminded that the presentation is for general advice only. So before acting on any recommendations or any ideas that we present today, please make sure you consult your financial advisor before doing so. And please remember, past performance is no indication of future returns. Comments and questions, all members will be able to pass on some comments and questions, and Angus and I will endeavor to answer as many of them as we possibly can. Where the orange arrow is, you can field the questions into the box during the presentation. If for any reason you can't hear us or you're having difficulties with the webinar today, please feel free to give us a call in the office, 1-300-88-1177, and we'll try to help you out there. So here we go, market update. It's been a busy week. There's been a lot of things going on in the market, and Angus, I thought we'd start with the U.S. 10-year bond has found a ceiling, and we saw the Wall Street decline sharply after Fed Chairman Powell raised concern on inflation overnight. But I thought we'd start with this 10-year bond chart, and we look forward to your comments on this.
Yeah, so I think, look, probably the first point to make is that, our base case is still that the 5% ceiling is in, and that, any rally that we see when I say rally, I mean sell off in the US bond and a lift in the 10-year yield towards that 5%. I think there is going to be quite a lot of buying support that will hold that 5% yield in place. But clearly, the volatility in the bond market hasn't completely settled down and normalized yet. And the one point, and I listened to Jerome Powell closely this morning when he was giving his speech to the IMF. He mentioned several times that inflation, the easy part of inflation going down, is now over, and that from here on in, getting inflation back down to target at 2% is going to be, it's going to be sticky, and maybe not necessarily a clear-cut trajectory. He highlighted a supply cost input pressures, labor pressures, a number of factors, commodity prices, as potential, roadblocks and hurdles for inflation getting back down to that level. So, cut a long story short, he sort of, basically said that, the Fed's going to be holding certainly for some time, and we shouldn't be anticipating rate cuts anytime soon. So, yeah, we saw that long end of the yield curve sell off, and we saw the 2 years push above 5%, which the stock market didn't like, and we were going to see some profit taking, I think, anyway, in the US stock market, given the big rebound of the last couple of weeks. So yeah, we saw that selling pressure coming through.
And the Treasury auction didn't go as well as they anticipated. There was some waning appetite there.
That's exactly right. And you might remember, Pat, that one of the reasons behind the big rally in bonds was the FOMC verdict and the press conference after, which provided a huge amount of lift with the stock market when those bond yields fell. And one of the trigger points was that the Fed had basically implied that they're going to cut back on some of the issuance that they were planning for the next couple of months. So yeah, it's concerning that Treasury auction didn't go well, and interest rates have reasserted to the top side. Although I've got to say, I'm sticking to our base case at this point that you know, the 5% will prove to be the ceiling for the US 10-year. And I think, look, this chart sums it up at the S&P 500, really at a technical crossroads. We've had this huge rally off that 4,200, 4,100 support level, and it's run straight into topside resistance at the primary downtrend from those July lows. So, you know, the big question really for the market is there enough impetus and upward momentum there really to trigger a breakout? And I think we'll find out, you know, what the answer to that question is next week. But it seems to me like at a minimum, you know, the rally has been pretty swift. It's been confined to a few stocks. Earnings breadth has been pretty narrow. The equal weighted S&P 500 and the Russell 2000 haven't followed. And, you know, we've seen the Magnificent Seven sort of leading once again on the upside. So, you know, it wouldn't surprise me if we saw a decent sort of a corrective sell-off next week. But, you know, it remains to be seen whether, you know, the S&P 500 is going to go back down and retest those lows at those October lows. We just don't know. And I think, you know, I
how
think a lot
far?
of it will. Sorry, you go.
No. I was just going to kind of ask you. You know, you're looking next week for a little bit of a correction. You think that'll be short-lived and kind of play out pretty quickly? Or do you think it's something that's going to hang around for a bit?
I think that it's really difficult to answer that. You know, because on one side we've got you know, a reporting season coming off the back of that huge GDP growth print. You know, things have never been as strong for the US economy, and we're now going into a growth slowdown. So you're going to get all sorts of downward revisions and lower guidance, you know, heading into the December reporting period, which gets underway in January. Doesn't sound like sounds like a long way off, but it's really just around the corner. If we could just look at this chart for a sec, this is the KBW Bank Index. You know, the banks haven't really followed in the US. The banks are in fact testing key support on that primary uptrend, which has been, you know, in place for the last 5 odd years. So, you know, if the bank index breaks down, then what does that tell you? It sort of says that there's trouble ahead for the US economy. That means the reporting season is going to be patchy. We're going to probably not get the growth that the market's looking for. So I still advocate a cautious stance, Pat. And whilst we can't rule out a topside breakout in terms of the technicals on that S&P 500, which then begins to lead the market to the top side, but that is for the market to prove. And, you know, we've had the best rally in 2 years, albeit from oversold levels. If we can just put that S&P 500 chart back up, you know, we went down to 4,100 and, you know, we had a meaningful bounce. The index managed to push back through the 200-day moving average and indeed the 50-day moving average, but the primary downtrend could be where it stalls. So I think at a minimum, you know, in the next couple of weeks, we've got to see a pullback to at least the 4250, 4260 level and, you know, a bit of a regrouping. But, you know, if the bond market continues to go higher, then, you know, that could be, you know, that could spell even more trouble for the stock market, because a lot of the rally last week was due to yields falling in the US, this feeling that the Fed is going to be cutting rates soon, the peak is in, but that's not what Jerome Powell was saying this morning. And I think that, you know, we've got to really watch out now for those CPI, PPI numbers due out next Friday. There's a lot riding on them in terms of what the bond market does and reacts and how it reacts, and also the stock market.
I think interesting as well is we've seen the credit card debt in the U.S. hit a record high, and this is probably going to put pressure on the economy as well.
Well, I think that, you know, the US consumer's tapped out. You know, and it's not just the US. There's a lot of countries where the consumer is tapped out. All those pandemic savings have gone. Spending is continuing which has kept the economy galloping, but people are now doing that on credit. And I think this is what we're seeing with the banks. The banks are factoring in harder times ahead for the US economy and potentially a hard landing. We had Ken Griffin join Paul Tudor Jones and Stanley Druckenmiller, all saying there's going to be a recession within the next 6 months. The banking index and the way that's behaving, it certainly looks like that. And I think we can't throw caution to the wind here at the moment. I think we've got to be one eye on what that economy is doing. So I still advocate caution heading into the end of the year, and it seems like a lot of the Christmas rally has actually been priced in.
If we stay on the banks for a second, we've seen some of the banks here in Australia report. The banks here have not really done too much either, have they?
Well, they haven't. The headline results have been quite good. Westpac had a thumper. NAB's result was okay. There's been demand for property, demand for mortgages. They've had sort of net interest margin expansion. That's all been good. But it's the outlooks that count. And, we saw that with NAB yesterday. They've sort of hosed down the next couple of quarters. They think, we're heading into a tough time. I think that rate hike that went through this week is going to really slow the Australian economy down. Will it push us into a recession? I don't know. But, it's certainly going to make it harder for people to go out there and finance loans for property. I mean, I was writing up this week in the Daily that, the affordability index is the lowest it's been in Australia for property since 1990. And there was, quite a severe downturn in the period that followed 1990. So, yeah, I think the banks, they're still in their big primary downtrends, which go back a decade, until we really see those banks convincingly break out above those big resistance levels. I would be still cautious, and I prefer to have the next RBA rate cut in sight before going along the banks. So in Australia, so I think we've got to be cautious here as well.
So I don't think there was any surprises this week. I mean, most people were advocating an increase in rates. We got the 25 basis points this week. Do you think that's the end, or you think they may have to go again?
Don't know. I think if they do go again, I don't think it'll be before Christmas. It'll be February. That's my view. They're going to leave it on hold till February because the amount of stress in the system is rising. It is, and we know that the structural makeup of the Australian housing market and the mortgage market is very different to the United States. The average Australian has not had access to a 30-year mortgage, and we're able to lock that in at 1% or 1.5% or 2% for 30 years. The average Australian, we're all paying higher rates now, even the ones that fixed. All those fixed loans are sort of rolling off. And so we have a much greater sensitivity and transmission effect from tighter monetary policy than the United States. So I think, 4.35 cash rate for us versus 5.25 for the United States. I mean, there is a risk that the RBA overshoots. I understand why they did it, and I think they had to do it, but I don't think they'll go again till February. And I think there's an even chance that that they won't have to go again. And I guess we'll know, in terms of the critical, retail spending cycle period that typically comes up, before Christmas.
You and I have spoken about it quite a bit. With these interest rates, I think we've both been pretty surprised at how resilient the Australian housing market's been. I mean, things are selling, auctions are getting filled, and still seeing some record prices. I mean, I guess it'll be interesting to see if this last increase slows things down as we head into the prime spring time, and just before Christmas things will probably slow down. But I think it'll be interesting to see how the Australian property market takes this latest increase.
I think we're very much got a two-tiered property market in Australia, with the top end not relying on debt. Most buyers being cash buyers, and so the level of interest rate and that strata of the market is a lot less relevant. But if we look at what's going on, with the broader property market, I think there's real pain, and I think we've seen prices surge this year on demand, being driven by just sheer fear, people renting and watching rents go up and go through the roof, and the housing crisis and shortage of rental properties to choose from and to live in. I think that has been a support construct for the broader market, but I'm sort of cautious, looking out over the next 6 months. This latest rate hike is just going to make it that much harder. And as I said before, Pat, the affordability for Australia is now back to where it was in 1990.
Yeah,
So
which is quite surprising. Yeah.
And you look at the unemployment rate at 3.7. I mean, it's only going to go up. Every day now, there's an announcement that comes through from a corporate about layoffs. Yesterday, it was Ernst & Young laying off 300. A few days ago, it was Macquarie Bank. So we're going to see that unemployment rate tick up. So yeah, the bottom line is I'm cautious.
How do you see the Russell 2000? We got the chart here, which is one we wanted to talk to. The small mid caps underperforming, and I think this is quite an interesting chart for that sector at the moment.
Well, small mid-cap stocks are a lot more sensitive to the economy than the large mega caps. They've got plenty of cash and a big moat around them. So this is probably a much more sort of accurate barometer of what's really going on in the US economy. And I think, consumer spending's about to come off. I think, unemployment's about to go up. And we know that small mid caps are a lot more sensitive to interest rates than those large caps. A lot of the large caps were able to raise lots of money and fortify their balance sheets at low rates, whereas a lot of the small mid caps are paying market rates over there. So, I think there is some pressure coming through. And this chart, it's not particularly technically bullish. What happens if that 1700 support level snaps? What does that tell us about the broader US landscape? When you've got, the majority of the small mid caps massively underperforming. We haven't seen underperformance like this for some time. Small mid caps typically come out of a bear market the first. They come out of it quickly. They restructure. They get reorganized, and they typically, lead on the upside. So, I suppose the question that we want to know the answer to is the Russell 2000 eventually going to turn up and then follow the S&P 500 higher? Does the S&P 500 break above resistance? We have another leg up over the next 6 months. Is the US going to head into a soft landing? Only time will tell, but it's not looking great with the Russell 2000 and the S&P 500 equal weight index underperforming like this.
So let's move on to the commodities and gold. And, I'm watching the screen. We're getting some questions from members about gold. So I think it's probably timely that we talk about the gold sector and this chart about gold. We've seen gold come under a little bit of pressure here lately, but everything seems to still be in play. With your view, I think that gold will probably outperform in the medium term.
Look, I think what we've seen this week is in energy and gold is the war premium dissipating. I think the market is now a lot more comfortable with the notion that the war in the Middle East, the occupation of Gaza, is going to be confined and contained to that region. I still think there's a question mark over geopolitical tensions. I don't think we can ascribe, no war risk premium. There is a lot going on in the world. And only time will tell, as to, whether the Israelis can extricate themselves from Gaza without, getting embroiled in a regional conflict. We won't really know the answer to that. But look, so far so good, and I think this is why we've seen the sell-off in oil and gold this week. It doesn't change my view about the longer-term picture or the medium-term picture, and I think the next leg of the gold bull market will be driven by a decline in the US dollar. But clearly, this big historical resistance level, up at sort of 2070, it is proving to be pretty formidable. We've seen gold now entering its fifth year in terms of a ranging consolidation. But, a series of higher reactionary lows, the fact that the primary uptrend's held, the technical setup is bullish. And, I'm thinking that, we're going to get a breakout and the US dollar gold price to record levels sometime next year when the US dollar begins to turn down and have another leg lower.
So do you just see these as a technical correction at this point in time? I know we were talking about the war premium disappearing. Here we've got the oil chart, and seems to be it might just be a technical correction.
I think it is a technical correction. I was surprised at the severity of the decline in oil. I didn't think it would get down to 75, but war premiums can unwind pretty quickly, and maybe that's what we saw. From that spike up to $90 a barrel a month ago, when the conflict in the Middle East erupted. I suspect that given the demand supply setup, fundamentals for oil are still very, very favorable, that it will find support at current levels and then begin to reassert the upside. We can still say that the technical setup looks bullish if the $75 level holds, because it's what I call establishing the first step above the base. And maybe we've seen the last of those longs that accumulated with that run to $96. Maybe we've seen them sort of flushed out, which now sets us up for a renewed push to the upside in WTI. I think what was quite telling, and I posted this in the daily this week, we didn't really see XLE, which is the Spider Energy Trust. We didn't really see it follow the oil price down to the extent that you'd think. There's a bit of a sell-off in the Australian oil stocks, but it probably could have been a lot worse. If this really was the end of the crude oil rally. So I'm still bullish on the energy complex.
And we've seen the US dollar remaining steady, which hasn't been great for the commodities either. Do you think that US dollar's got a leg down coming?
I think still a question mark over the Aussie. It sold off after the RBA raised rates on Tuesday. It was down. Normally tightening is seen as a good thing, narrowing interest rate differentials, enticing capital flows back to Australia. I think when the RBA hiked rates, I think the Aussies' reaction was more one of, is this going to be the rate hike that pushes us into a recession? So I don't think the Aussie dollar is quite out of the woods. And, for this reason, I still think that, the miners and the resource companies, the energy companies, the gold miners, the iron ore producers, I think they're all in a sweet spot, with the Aussie still set to remain under pressure, at least for probably the next 1 or 2 quarters. And, we've got still elevated spot prices in the underlying commodities themselves.
So as we continue down this, I thought we'd just talk a little bit about China. You know, China's population levels are on the rise, and does this support the case that the economy is stabilizing over there?
Um, I'm not. Yeah, I actually thought there was a question mark over China's population. Um, but what we can say about China is that um, all those initiatives taken by the government are beginning to collectively add up cumulatively, and this could have begin to soon have a positive impact, um, on the underlying economy. And whilst the performance of the benchmark indices has been very poor, we've seen major companies like Alibaba, one of the largest tech giants, um, you know, in China, sell down to a multiple of 8 to 9 times. These are historical lows. Um, I think that um, you know bear markets typically bottom on maximum pessimism. We've seen foreigners deserting China in droves, and Hong Kong, and the valuations on those stocks, are back to levels not seen in many decades. So I think it is interesting, and you just got to look at the iron ore price. It reached went above 120 US a ton. In fact, it's closing on 130. I mean, if the economy was really that bad, you'd expect iron ore to be at $70, not 130.
Okay, got a question here, Angus, for lithium. How do you feel about lithium at the moment?
I'm still a bit cautious. I think there were bubble-esque um, dynamics that drove lithium prices, and we're seeing a supply response. And I think we've now seen the big sell-off from the peak. I think it's going to take a little while for the dust to settle. So I'd be on the sidelines with that one. I feel stronger about the gold stocks, which are 50% below their peaks from sort of 3 or 4 years ago, and yet the spot price of Aussie gold is almost at a record level. I feel quite good about the diversified miners, BHP, Rio, and Fortescue. With iron ore holding in holding in there at sort of 125, 127 US a ton, and the uranium stocks. We've seen a decent correction there. I think that's these are better sectors to be looking at the moment, simply because the uranium price is coming out of a decade-long bear market, whereas the lithium has been in this big sort of inflated, this big run, if you like, for some time. So it doesn't make sense to try and catch a falling knife. So I'd be on the sidelines with the lithium sector at the moment.
Got a couple questions here just on, can Angus comment on Bitcoin and the recent moves in the Bitcoin price?
Look, I like the cryptos. We don't trade around in that space. They've had good technical breakouts and reassertion to the top side, and I guess we're old school. We're old school. Um, we're old school, but I prefer things that are heavy and real and tangible. Um, but there is a place for cryptos. Cryptos are probably going to be part of the e-commerce ecosystem at some point, in a major way. I think they have stood up as, with the blockchain technology, they've stood up as a store of value. And, I think there is going to be a place for them. We just don't choose to own them in our portfolios. And I think, if we look at what the precious metals are doing, and they behave in a similar way to the cryptos, you've got the actual gold miners themselves trading at very cheap price to cash flow multiples. So I think there's a better opportunity in the actual miners. But But I think the cryptocurrencies, there is a place for them, definitely.
Okay, and next week, you've got a big week next week. What are some of the things that you're looking at for next week that will impact the market? And I think you're off to a conference as well, which probably will be quite interesting to hear what's spoken about at that conference.
Oh, look, it's always a busy week when I do the Singapore conference every year, and it means I've got to get up at like 3 o'clock in the morning, 2 o'clock in the morning, as opposed to 5 o'clock in the morning, and so I'm not looking forward to that, Pat. But like, I do get a lot out of these conferences. They go for 3 days and they're packed, with presentations and meetings and speeches, etc. And the things that I'll be really tuning into next week will be, what's going on in China. Um, what's really going on with the economy? Is it getting better? I think it is. I think it's quite telling that President Xi's done this huge pivot politically on the centre stage. He's made friends with Australia. They obviously the economy is back now as one of their principal focuses. So I want to hear more about that from people on the ground. I want to find out what's really going on with that property market. We know it's struggling, and it's been struggling for a number of years now. But is it getting better? And so I'll be focused on that. I want to hear more on the strategy front. About what the strategists still think in terms of the US economy. Is it going to have a hard landing? And I always like listening to the energy, the guy that talks about energy, their energy expert. He's he sort of nailed a few years ago. He spoke about the renewables and how there was going to be a hole left in terms of fulfilling the transition to green energy. Renewables were not going to be able to do all the heavy lifting. So it'll be interesting to hear from him. And of course that's why we've seen the big recovery and the rally in the uranium sector this year.
What about Japan? You still,
Well,
I know the
I,
banks and
I go every year, and I hated Japan. Um, and then lukewarm, and then it's almost like everyone's all over Japan now. So it'll be good to hear about Japan. I know we're still very keen on it. I think it's got and a ways to go. After the stock market has underperformed GDP for so many decades, it seems to me like there's a lot of catch up there. So yeah, it'll be interesting to hear about that.
okay, well, I think that covers most topics we wanted to get through today and most of the questions that have come through. Have a safe trip next week, Angus, and we look forward to hearing some of the things that you got out of that conference next week. And we want to thank all the members for joining us today. Again, we apologize about yesterday. That was just something that was out of our control. And we wish everybody a nice weekend. And we'll say bye for now.
Bye for now, and look forward to joining you at the same time. Probably not next Friday, Pat, because I'll be in Singapore, but the week after,
Okay.
I'll be back on the webinar.
Okay, thanks again, and everybody have a nice weekend.